Thank you so much for making time for us on the Trading Bell. My name is Maalika, Kazia, and today we're going to be talking to KCB Group Chief Executive Officer and Managing Director Joshua Oigara. Of course, KCB has just released their results. We're going to be taking a look a little bit deeper into that and a lot of other factors that are affecting not only the banking sector as well as the economy. But first, take a look at his profile. Joshua Oigara, CBS, is a member of the KCB Group PLC and KCB Bank Kenya boards, as well as the KCB Group Chief Executive Officer and Managing Director. He is the chairman of the Energy and Regulatory Commission of Kenya, a director of the Vision 2030 Delivery Board, and he was commended by His Excellency President Uhuru Kenyatta on the award of Chief of the Order of the Burning Spear, CBS, for exemplary service to the people and nation of Kenya. He is also the chairman, Kenya Bankers Association, the banking industry lobby. Listed as one of Africa's top 25 leaders to watch based on his role to champion transformational leadership and change on the continent by the Financial Times, Joshua actively engages at national and industry levels to drive this agenda. Joshua was named among the top 100 youngest and most influential economic leaders in Africa. He was recently named CEO of the Year in East Africa by The Banker Africa and captains the largest indigenous bank in the East African region with assets of over $6.5 billion and a market capitalization of over $1.4 billion. Thank you so much for joining us.
Thank you.
So we begin with the numbers because we have seen a 5% jump in profit after tax, just about 25.2 billion shillings, I believe. If we look at the numbers in terms of earnings per share, they jumped to around 8 shillings 11 cents from 7 shillings 83 cents. What exactly has informed these numbers? What can you tell us more?
So it's been a good year, I would say, if we compare the momentum of our business from last year. Remembering this is the first time we are reporting with the National Bank of Kenya within our group numbers. But strong performance on our overall businesses, so whether it's our interest income from our loans have increased by 17%, and that's inclusive of NBK, it's 26%. If you think a little bit about our mobile loans, that has been a very strong growth. It's a double-digit growth. It's actually 2x growth from the previous year. But our fees and commission have also grown strongly on a year-on-year basis, including our foreign exchange income. So in terms of top line, our total income is up 17%. And we've also seen strong performance from our international businesses, whether it's in Uganda, which has been a difficult year for Uganda, but Tanzania, Rwanda, Burundi, and South Sudan have delivered strong performance. The area that we didn't perform very well is around the provisions for our loans. So our cost of risk increased last year, almost doubled from last year. But that's an issue largely because of the volume of loans we are underwriting on our mobile loan platform today. But that's an issue we should recover in the year 2020. But overall, I would say on a PPT basis, 9% up. On a PAT basis, 5% up. It's a strong performance for our group.
You did mention NBK, of course, and we saw KCB inject about 5 billion shillings in December. Recently, they did open their first branch in Gikomba after the acquisition was completed. Tell me a little bit more about the strategy there.
So NBK has I would say, a strong value proposition for a number of customers that they had. So the game for NBK is to increase market share. Yeah. So there was a lot of concerns around it's a badly managed bank, it does not have capital. The greatest challenge NBK had was simply one challenge. They didn't have the capital. And without capital, you couldn't lend, you couldn't open up a branch. So what we see now is rebuilding those steps. In the public sector, they have perhaps the strongest brand you can have today. So although initially our view was to buy NBK and integrate all the branches in KCB in a period of 2 to 3 years, we are now taking much longer to understand the value we can create by building the focus of growing market share. So if I explain it simply, we saw NBK as a market share 1%. But from bringing the business together and recapitalizing it, it does look that combined with KCB, it can increase market share to 3%. It's a very solid bank.
Absolutely.
Yeah. So that's the strategy is build on the synergies that you have. Once you can exploit those synergies, you can then consolidate. But you need longer term. So we are not as quick as enough today to stay closer. And for them, Gikomba that branch had been outstanding for a while. It's been up waiting for capital.
Okay.
Yeah. So there wasn't like any new thing they had to do. But they will also close to 8 branches this year, open 5 branches this year. So obviously there's a reduction in the overall footprint.
So it's just gaining momentum with existing plans for now, right?
Yeah. And customers, I was in the MK branch, and a lot of customers have come back with their feet voting for their brand. Yeah. It's not that they're empty. So there is value, and sometimes we have a different view outside, but when I looked at the clients that they have, the customers I've spoken to, remember it's a very national heritage brand. Yeah, obviously NBK is not the same size as KCB, but we can co-create the two brands together. If naturally we combine them after 2 to 3 years, it will be a stronger brand you're combining. Today, we're only going to combine a 1% market share, which I think is very little. And
this combination of brands, I mean, we've seen that trend taking place in the banking sector quite widely, especially in the past year. Do you think that's going to continue? And do you think it's more to do with the fact that, you know, some would say we're overbanked? We have too many banks in relation to our population.
Well, I mean, I would say that things have now changed. If you look at the transactions customers are happening, they're not happening in the banks anymore. I said 97% of our transactions are happening on a digital footprint, so mobile and agency. So if you look at the traditional model, if you are not moving investment towards digital platforms and solutions for customers in terms of savings, payment, and lending, I don't think you'll have a business to run. So I presume the combination of banks is a national reaction. Double your investment, have the talent and skills to run your digital platforms. That's what is driving it. Yeah. And then finally, the customer's experience and the customer kind of value has changed. They are looking for a digital partner for themselves. This is what is driving it. And it's nothing new. Central Bank has also been pushing banks and saying, if you don't have something you're playing that is strong, find a collection. Yeah. So it's not, so you have to really seek each other
to survive and thrive.
This is true, and this is naturally in the market. I believe that 20 banks is really what the industry will look like in the next 3 to 5 years. There's something they call banking per capita, but it's too complex to explain it. In the past, we had 47 banks for 45 million people. So you have a bank per million. Well, that's crazy.
Yeah. So you're looking at probably halving the number in the next half
decade.
It's like
2 million customers, 2.5 million customers per bank. You can then talk about cost of credit is lower, efficiencies were delivered today, customer experience is the same that is delivered and is consistent. That's what Nigeria is doing. Remember, we have to reimagine a bigger ecosystem for Kenya as an economy. Maybe for too long we thought very small. And there isn't really much value in the global economy to be small. It doesn't.
Okay, if we're talking about access to credit, and like you said, you know, going digital, mobile lending is big, great percentage as well. We talk about the rate cap being repealed, and of course the access to credit was supposed to become easier. Do you think that has been the case so far?
So today we don't see a queue. You know, people were saying, so there wasn't, I think the repeal has been very valuable. But whether customers are coming and rushing in for new loans, remember, they had gotten a very much excitement about mobile loans. We're seeing new developments, so we are growing. We project a 15% growth this year. So the removal has been a tipping point, correct? So loan growth should taper, will go to 15%, you know, in this year. We're already seeing it is 8% or last year. And overall, those customers do not qualify will get a chance to be able to get their level of credit that they have. So that's a very natural positive. Small enterprises, micro businesses, nano entrepreneurs, you know, those who have no chance at all. This is the greatest position for themselves. Now, there are two gaps. One, there were delayed payments, which are now being resorted out. And if they are in traders, then there were challenges this year that their goods and services may take longer to arrive from their main suppliers, like from China. But those are issues that should be resolved sometime this year.
Yeah, actually, that is exactly where I was going to go, because a lot of small traders have supply chain issues right now. So do massive firms, because their goods are blocked with the coronavirus. So what, in your view, would be the contingency here, if any?
Well, so businesses have to find new supply chains. This is the most difficult assignment, right? It's like finding a new road if your new road to the airport has been closed. It take you much longer. But I believe naturally the world will start shifting into a new model of supply, of having alternative supplies. So I presume we may look into India, we may look into countries like Turkey and others in Europe. Yeah, we may look into this. For me, I say that it's time for countries to supply, to increase their level of supply chains than before. We don't know how long the global pandemic will take. But in my view, the short term, so assuming it takes this whole year or 6 months of this year, we have to reorganize the financing structure for our customers to ensure they can survive the curve. That's what we will do. But I can guarantee you that businesses, large manufacturers, and SMEs will find new supply chains for themselves this year, not just for coronavirus, but for the future.
Okay, and if we look at it from a macro perspective, of course, we've seen the hit that the Dow, the FTSE have taken with regards to this, as well as, of course, our own NSE as well, in terms of a lot of investors, selling out majority of their shares. Do you think that is there a way to sort of prevent this kind of panic move?
Well, today, with the coronavirus, it's a serious global occurrence. You cannot, it's like a serious shock to the global economy. Yeah, and there's really no way of you can prepare yourselves. But I would say that we haven't seen major reaction
yet
in our markets.
Okay.
So yeah, globally, yes. But in our market, generally, we haven't seen as much shock. And I would say that the impact is something that we are studying over time. And so the global markets have seen a dramatic hit. We don't have a case yet in our country today, but there is a lot of preparations happening at the National Task Force, and a lot of us in private sector are already engaged. So the answer for you that it's not natural for markets to panic, but markets respond when there's a stimulus to contain the source of the panic. And I think so far a number of countries, especially like China, and especially North America, you can see some response. And what I should say is that even in Kenya, the issue is to increase our preparedness, and that's why we're working very closely with the National Task Force on this kind of emergency. But market will recover. I would not say that people should see the drop as a systemic shock. No, we've had shocks before. We had a financial crisis before. Yeah, we had Ebola next door before. We had oil slump price before. Yeah, and we had even Brexit before, and we kind of recover. That's the nature of the financial markets.
Absolutely. Coming back to within our borders, of course, we have seen that there seems to be this pessimism, especially when it comes to the economy, and when we look at inflation rates, when we look at the common man buying tomatoes and the rates at which they are, if we go completely to the grassroots level, we've also seen that a lot of small businesses are not able to sustain themselves because the spending power right now is very weak. What would you say about that?
So what we are not excited about is the translation of the growth of the economy, what you call GDP, into the pockets of an ordinary person in the country. That is really the challenge. Do we democratize, or do we share that value with everybody else? And this is the message. Even the governor of Central Bank has raised this issue before. And I would say there was delayed payments for small businesses by national government and county governments, right? That was a major issue for them. They had no access to credit. If you remove those two catalysts, you will see lack of cash.
Yeah.
So with the repeal of interest rates, with the payment of pending obligations happening, I think we are poised for a takeoff. The only downside we have is around the global pandemic for coronavirus. But generally, we're in a very good positioning today. So as price of goods haven't changed very much, actually. Inflation is very well managed. It's at 5.1%, correct? But that inflation for some people, remember you look at the basket, some people may be spending more money on foodstuffs, right? Isn't it? Maybe you go to someone else, maybe out of town, maybe in the village, you may find that people are spending much more. And maybe that's the need that needs to be addressed in terms of, ensuring that there's inclusive growth everywhere you have in our economy. So I'm positive today, yeah. But businesses need credit. Businesses need to be paid their supplies. And those two catalysts is how you create income in the local areas. Mashinani is what they say.
Yes, so the pending bills are obviously
they
key
haven't
there.
paid, but they have been paid. Majority have been paid. They are pending. There are some outstanding.
Yeah.
But let's look at, I like always measuring progress.
Yes.
So if they have paid 100 billion, maybe there is 300 billion, but it's 1/3 of the problem half solved. So I am not a pessimist. I am a more convicted optimist in the way we see the running of the economy.
Okay, and even as we wrap up, the Japan partnership that KCB is looking at, tell us more as we close up.
So we see that as a new frontier for us. So, China has been a big partner for us, but this is a follow-up to the Tokyo Investment Forum, or what they call TICAD.
Okay.
Yeah, and that's how we've been continuing. We have a number of supplies here from Japan on energy sector, on manufacturing sector, on motor vehicle sector. And Japan is very advanced in terms of their own capabilities on engineering. So what our partnership there is to be able to bring in a natural flow of goods and services for Japanese entrepreneurs. Yeah, remember when Shinzo Abe, the Prime Minister, was here before 3-4 years ago, they signed a global national conversation. We even hosted the TICAD here in 2016.
Yeah.
So that's what we are following up ourselves with Japan in terms of bringing those businesses here, not as an opposite to China, but but just to build the engagement for the businesses we have. So we are providing trade finance, lines of credit, and new businesses between Kenya and the entire of Japan. And I think it's an exciting opportunity.
All right. Thank you so much for joining us today.
Thank you.
Thank you for staying with the Trading Bell. Let's get right into the markets and the numbers. And joining me from NCBA is Elizabeth Wangeshi to dive into what exactly is causing the movements. Thank you for making time for us, Elizabeth.
Thank you for hosting me.
Well, let's begin with the fact that the all-share index has actually seen a dip of 3.55%. Looking at the NSE 20 share index, it's gone down by 3.58%. So, of course, these movements, most would assume they are associated with the coronavirus and the fact that global markets are seeing shifts and dips. What do you have to say to that? And, of course, getting into the effect it's having on the Kenyan market specifically and then globally.
Wow, it's been a bit shocking looking at the NSE All Share Index. Week to date, it's lost about 3.5. If you look at month to date, it's about 7%. Year to date, it's about 9%. So it's just an indication of how investors are reacting to the external shocks, and the external shock here being coronavirus. We've seen foreign activity actually increasing, and why it's increasing, it's because of the outflows. They're selling out from the market, basically exiting, and because their main portfolio interest mainly is on Safaricom equity KCB. So we've seen a bit of sell-offs starting the month of January and even right now. So the situation is more of rebalancing from an equities perspective to more safer havens. Yes.
Okay, well, you're right, because we've seen as our top movers, of course, Safaricom is up there, equities up there, Cooperative Bank, Kengen, CIC Insurance Group as well. But when we look at, international markets, FTSE, the Dow and the likes, we've seen, again, major downturns. So is there any way to really safeguard ourselves from these kinds of panic moves?
Right now, there is nothing much that we can see, because what you're seeing is a shift from equities, as I mentioned earlier, to more safer havens. If you look across US, the markets are actually crashing. All the markets are on the red. So that means investors are pulling out from the equities market. And it's just a fear of the coronavirus effect. So most investors are now tending to just exit. But now the question is, when will this subside? Is it after? Because you don't know how long this will continue becoming a threat to the country. So that's still a question we're also looking at as analysts.
And I'm sure it's so difficult to ascertain, because the virus, keeps popping up in different countries. You're seeing the levels changing all the time in terms of the people growing who are affected in different countries over the world. So it is very difficult. Another thing that has been, of course, making headlines is the fact that businesses are trying to maneuver their way out of the fact that their supply chain is going to be disrupted so heavily, because so many of our materials come from China. Do you think there is any solid backup that most businesses have for this kind of situation, or not really?
Right now, no. I don't think there is any backup on that, because first of all, the supply chain is disrupted. We saw last year that being a major challenge even globally, and that's why we saw a slowdown even in global economic growth. So even right now, the fact that we are importers, we are not getting much from China, and the options are also reducing, because now this is more of a global pandemic. So I think that will remain to be a threat for this year's economic growth.
Okay, so troubling times there, of course, when we look at the markets world over. But for now, let's take a look at Markets 101. Well, now let's take a look at our question on the street. Of course, you can send it to us via Twitter as well. And today, the tweet that we've decided to pick and answer for you is to do with this question: have people been able to get loans more easily after the rate cap was lifted? So, Elizabeth, I'll let you answer that.
Thank you for the question. So even looking at how credit growth has been moving, last year we closed at about 7.3%. That's the private sector credit growth. The expectation is that this year it will probably be between 10% to 15%. But the question is, are banks still lending to consumers? We have not seen a lot of traction on the lending aspect. I think because even our economic cycle right now, external shocks of coronavirus, and also banks haven't yet come up with a good pricing strategy to price in risky consumers. So the main activity we are seeing mostly is on the informal sector, lending through mobile apps. So that's where we are seeing major tractions. But one-on-one lending on banks, there has been a slowdown.
All right, thank you so much for answering that question for us. And right now, let's take a look at the NSE historical fact. Well, that's all the time that we had right here on the Trading Bell. Wangeshi, thank you for joining us and, of course, giving us insights into so many issues that we've discussed today.
Thank you for hosting me.
Absolutely. All right, you can keep up with the Trading Bell because we have our social media handles that are active. They're appearing on your screen right now. And of course, today when we looked at the markets, we're seeing a lot of movements when it comes to those that are being caused by the coronavirus globally and that are also affecting Kenyan markets. So we will keep on keeping watch very closely for you. Keep up with us here on the Trading Bell for that and so much more. My name is Maalika, Kazia.